Hi, I'm Larry DeBoer. I'm a professor in the Agricultural Economics Department at Purdue University and an extension specialist with the Purdue Cooperative Extension Service. And this is another in our series on local government. The topic for this segment, the tax cap referenda, November 2nd, 2010, Part 1. Well, we've got a referenda coming up on November 2nd to amend the Indiana Constitution, and what the question being asked is, do we want to take the new tax caps that we're operating under now and actually incorporate them into Indiana's Constitution? And when the voters walk into the voting booth on November 2nd, what they're going to see is this, the tax cap amendment ballot language here. It's going to say, public question number 1, shall property taxes be limited for all classes of property by amending the Constitution of the state of Indiana to do the following? And what I thought is we'd go through what the language says and explain just what it is that this tax cap amendment would actually do. Well, the first thing here got highlighted in red, and I'll read this to you here. It imposes caps on property tax bills. It would eliminate a taxpayer's annual property tax bill to the following percentages of gross assessed value: 1% for an owner-occupied primary residence, that's a homestead; 2% for residential property other than owner-occupied primary residence, including apartments, that's mostly rental housing; 2% for farmland; 3% for other real property, that's mostly commercial and industrial land and buildings; and 3% for personal property, which is mostly business equipment. Well, what does this mean? How do these tax caps work? We know how they work because they are in law right now and we are working under these rules right now. Here's how they work. For a homestead, if your home is assessed at $120,000, if that's the value that the assessor puts on your home based on an estimate of its market value, of its potential selling price, that would mean that if it qualifies as a homestead, if you live in the house that you own and it's your primary residence, that qualifies it as a homestead, then your tax bill would be capped at 1% of that $120,000 or $1,200. You could not have a tax bill higher than the $1,200 tax cap. If your tax bill actually came in at $1,300, if the tax rate times your taxable assessed value produced a bill that was higher than that tax cap, you would get a tax credit of $100 to bring the bill down to the cap. That $100 of property taxes that you don't pay is revenue losses for your local government. Your local governments would receive $100 less in property tax revenues, and that $100 would be divvied up, that $100 in losses divvied up among the county and the townships and the cities and towns and the school corporation, the library district, and the other local governments in which you live. The tax caps for other kinds of property, for rental housing, farmland, commercial and industrial businesses are higher, are 2% and 3%. So a 2% limit on $120,000 would be $2,400, and a 3% limit on $120,000 would be $3,600. Well, that's how the tax caps work. Now, if you take a look at this public question number 1, you'll see that there's a sentence right below that description which says this: the above percentages exclude any property taxes imposed after being approved by the voters in a referendum. Now, there are two kinds of referenda that we use in Indiana now, and one of them is new as of November 2008. As of that date, we began to put big capital projects, infrastructure projects that local governments propose to a vote of the public. That is, if the school corporation wants to build a high school, if the county wants to build a jail, if the library district wants to build a new library branch, they have to put that to a vote of the public before they can raise property taxes to pay for the borrowing that would be required in order to build those buildings. Well, this says that those tax rates passed in a referendum are outside of the tax cap. The other kind that are outside the tax cap are the school corporation general fund referenda. And these are referenda that we're seeing quite a few of lately, where the school corporation asks its citizens and taxpayers and voters whether or not they can increase taxes to provide more revenue for the general fund, which is their operating budget, mostly used to pay the salaries and benefits of teachers and other employees. Well, why do we have this exception here? Why are we weakening the caps with this exception? It's really for two reasons. One is, if you were already at your cap and you walked into a voting booth and the referendum rate was inside the cap, and you saw, hey, here's a new high school that the school corporation is providing, and you thought, well, it sure would be nice to have this new high school, and then you asked yourself, how much is it going to cost me? The answer would be zero. If you're already at your cap and the referendum rates are inside the cap, you could get the benefits of the new services provided by the new facility without actually having to pay anything for it. And in that situation, people are very likely to vote yes. And so what the legislature decided was that if you walk into the voting booth and see a capital project or a school general fund referenda on the ballot and you vote yes, you are saying, yes, I want that facility, yes, I want those services, and yes, I'm also willing to pay for it. The other reason for having this here has to do with the bond market. The bond market is where money is borrowed for these big capital projects. And the bond market is very sensitive to rules that restrict the repayment of debt. If we put a cap on what can be raised to repay debt, the bond market will say, hey, maybe we're not going to get paid, maybe we're not going to have our loans repaid. And if they think that, then they'll regard Indiana local government bonds as more risky and will charge us higher interest rates. So for those two reasons, the referenda rates are outside of the caps. Last thing that the tax cap amended ballot language says is specify that the General Assembly may grant a property tax exemption in the form of a deduction or credit and exempt a mobile home used as a primary residence to the same extent as real property. People may look at this and say, well, what is this amendment about mobile homes? And in a sense it is, in that the amendment actually crosses out 3 instances of the word real that are currently in the Constitution. Real property is land and buildings. Mobile homes are assessed as personal property, as equipment. And so it's not at all clear in the Constitution now that tax breaks that go to homesteads will also apply to mobile homes. And this will clear up that confusion and actually make the Constitution consistent with what we actually do, which is provide those tax breaks to homesteads that happen to be mobile homes. The amendment will actually do one more thing, and that is Section H of the amendment. You can see the various sections of the amendment here summarized. Section H is the Lake County, St. Joseph County debt service exception, which expires in 2020. Turns out that Lake and St. Joe were going to lose so much revenue to these tax caps that the legislature said, we will exempt your current debt service from the tax caps. So the tax caps are not as tight in Lake and St. Joe, and the constitutional amendment actually incorporates that into the Constitution. It expires in 2020, and also you might note that because taxes passed by referendum are outside the caps, most other counties will be moving in that direction as well, because debt service passed by referendum will be outside the caps. So it expires in 2020. All the other counties will be in the same, under those same rules within a few years. Well, the effects of the tax cap referendum. What are the effects? One thing to notice, no added tax relief from the referendum because the Indiana Code already imposes these rules. We're already operating under these rules. What it will do is to restrict future property tax policy changes. The legislature will not be allowed to change these tax caps, and it will also restrict other efforts that they might make to raise property taxes in the future. This will put a rather hard ceiling on the use of the property tax for local government. Another thing the referendum will do is it will prevent potential constitutional challenges. The Constitution we have right now reads that the legislature will provide uniform and equal rate of property assessment and taxation. Well, 1%, 2%, 3% doesn't sound very uniform. The rules that we have right now in the code, the tax cap rules, might be vulnerable to a constitutional challenge if we don't amend the Constitution. If we do amend the Constitution, then the rules are in the Constitution. By definition, they are constitutional. The other thing this does is add code language to the Constitution. It's got a definitions section. It's got an expiration date. That's the stuff that we have in the past put into the Indiana Code, into law, rather than into the Constitution. So this would be a departure from the sort of thing that Indiana has done in the past. Well, those are the sorts of things that one might expect from the tax cap referenda that will be on the ballot on November 2nd, 2010. This was part 1. Part 2 discusses what we know about the operation of the tax caps already. This is On Local Government, and I'm Larry DeBoer.
Excellent timing.